Hello, my name is Margaret Louis, CEO of Azalea, and on behalf of the management team, I would like to thank you for taking the time to view this presentation on Astrea V. Please note this important notice and that the prospectus in respect of the offering by Astrea V Private Limited of the Class A1 bonds in Singapore is available for collection at selected DBS POSB branches during operating hours until 12 noon on 18 June 2019. And anyone wishing to acquire the Class A1 bonds will need to make an application in the manner set out in the prospectus. This advertisement or publication has not been reviewed by the Monetary Authority of Singapore. This is the management team who has been involved in developing the Astrea transactions since 2016. Chu En Yao, Managing Director, Head of Private Equity Funds, will later join me in this presentation. Please take a moment to review the legal disclaimer. I will kick off the presentation by providing a summary of the transaction, an introduction to the Azalea Group, and then go through a private equity primer. I will then hand the time over to En Yao, who will provide you with an overview of Astrea V, the key takeaways, and conclude the presentation. Astrea V is offering three classes of PE bonds amounting to $600 million. A portion of Class A1 bonds are offered to retail investors in Singapore through the public offering. The remaining bonds were distributed to institutional and accredited investors through a placement offering. The bonds are backed by cash flows from a diversified quality portfolio of private equity funds of US $1.3 billion. Class A1 bonds are expected to be rated A+ by S&P and A by Fitch, both of which are investment-grade ratings. The bonds will also be listed and traded on the SGX. This slide shows the key credit strengths of Astrea V. Firstly, the bonds are backed by cash flows from a diversified quality portfolio of PE funds. Secondly, the portfolio value is more than twice the amount of the bonds issued, with a loan-to-value or LTV of 45.3%. Thirdly, there are structural safeguards in place to ensure that bond interest and principal repayment are paid on time. The table on this slide provides an overview of the three classes of bonds being offered in Astrea V. The Class A1 bonds are denominated in Sing dollars, with a tranche size of 315 million Sing dollars. 180 million Sing dollars is offered to the public at an interest rate of 3.85%. The remaining $135 million were placed out to institutional investors to price the bonds through a book building exercise. The Class A1 bonds are scheduled to be redeemed on its fifth year, if conditions are met, on the 20th of June 2024. Class A2 and Class B bonds are placed out to institutions and accredited investors. All classes of bonds have a final maturity of 10 years. The next few slides provide a brief introduction to the Azalea Group. Azalea is the parent of the issuer and manager of Astrea V. We were set up in 2015 and are wholly owned by Temasek. We have our own independent board and management team, and Azalea is an investor, developer, and manager of private assets with an initial focus on private equity. Our management team has extensive experience in PE, and we successfully developed and listed Astrea III, the first PE bond in Singapore, and Astrea IV, the first retail PE bond in Singapore. Astrea V is the latest PE bond that we are launching. One of our goals is to develop innovative products that are sustainable for the long term. We seek to broaden access to investors by creating new investment opportunities and products for investors with different risk appetites. Lastly, we are fully committed to investor education for our products. That is why we are here today to share with you about private equity and the Astrea Platform. The vision to broaden access to private equity started in 2006. Temasek initiated the Astrea Platform with Astrea I. It was a securitization of 46 quality PE funds. Two classes of rated securities and two classes of unrated securities were issued to institutional investors globally. The two classes of rated securities were rated by S&P and Moody's and maintained their credit ratings throughout their tenure and were fully repaid in 2011. In 2014, Temasek launched Astrea II. Astrea II was a sale of equity interest of an entity which held a well-diversified portfolio of 36 quality PE funds, thereby establishing an equity benchmark. Azalea was then set up in 2015 to further develop the Astrea Platform. In 2016, Azalea launched Astrea III, the first listed PE bond in Singapore. Astrea III was an issuance of $510 million of 4 tranches of notes backed by cash flows from a $1.1 billion portfolio of private equity funds. The notes were offered to institutional and accredited investors. In 2018, Azalea launched Astrea IV. Astrea IV was an issue of $501 million of 3 tranches of bonds backed by cash flows from $1.1 billion portfolio of private equity funds. The bonds were the first listed retail PE bond in Singapore. This was a significant step in achieving Azalea's vision of connecting retail investors to private equity. Astrea V is an issue of $600 million of 3 tranches of bonds backed by cash flows from a $1.3 billion portfolio of private equity funds. It represents a continuing step to bring retail investors in Singapore closer to private equity through listed retail PE bonds. The Astrea 3 and 4 Class A1 bonds were rated A by both Fitch and S&P at launch. Astrea 3 was upgraded by Fitch and S&P to A+, 1 year after its launch. In May 2019, Astrea 4 was upgraded by Fitch to A+. The Astrea 5 PE bonds are innovative yield instruments based on diversified portfolios of PE funds, with the most senior Sing dollar tranche being accessible to retail investors. They are structured to provide safeguards for bondholders and are a continuing step to bring retail investors in Singapore closer to PE through listed retail PE bonds. This slide introduces the Astrea V board members. The board has a balance of skill sets, including veterans with rich experience in private equity, capital markets, and corporate governance. The gentleman on the top left is Dr. Tay Kok Peng, the chairman of Astrea V Board. He was the former president of GIC Special Investments, which oversees private equity fund investments of GIC. Before we discuss the Astrea V transaction, I would like to spend some time on private equity, which is the underlying asset class of the transaction. This will provide some insights on the portfolio that underpins the Astrea V bonds. Private equity in general refers to investments in private companies. Majority of private equity investments are made by private equity funds. The funds strive to make operational improvements and create value to these companies before selling them for a profit. The PE funds are managed by private equity managers, also known as general partners or GPs. Investors are commonly referred to as limited partners or LPs. There are various strategies in private equity like buyout, growth, real estate, and venture capital. Astrea portfolios are focused on buyout or growth strategies, which invest in companies with established businesses and high growth businesses. For general information, here are some examples of private equity owned companies, many of which you may be familiar with. As shown on this chart, the private equity market has grown significantly since year 2000, growing at an annualized rate of 11.4% to reach 4.5 trillion US dollars in 2018. In terms of returns, private equity as an asset class has also outperformed the public markets over the longer term. Of the various PE fund strategies, the buyout and growth equity strategies have produced consistent median returns of 14.1 and 13% respectively. And the Astrea V portfolio is strategically weighted to these strategies. A characteristic of private equity investments is the J-curve. Let me explain what the J-curve is. Private equity funds typically have a fund life of 12 to 13 years. In the initial 4 to 5 years of the fund life, investors experience net cash outflows due to drawdowns to fund investments and fees. Investors receive net cash inflow in the later years when the investments mature and are exited. The effect is also known as the private equity J-curve. As shown by the shaded area of the graph, seasoned PE funds several years into their fund lives are cash flow generative. The Astrea V portfolio has a weighted average fund age of 5.4 years and is in the cash flow generative phase. When a portfolio of PE funds is constructed, it can have superior downside protection versus investing in a single PE fund. Here, we compare the risk of capital loss of a single PE fund, a primary fund of funds, and a secondary fund of funds using historical data from Preqin, a database provider, covering more than 7,000 funds from 1990 to 2015. A primary fund of funds is one that invests at the inception of the funds, whereas a secondary fund of funds acquire interest in seasoned funds through secondary market purchases. Investing in a portfolio of secondary fund of funds has competitive risk-adjusted returns with lower risk of capital loss. Based on funds' historical performance from Preqin, only 1.4% of secondary fund of funds experienced a capital loss. Similar to a typical secondary fund of funds, the Astrea V portfolio is well diversified, seasoned, and cash flow generative. PE is traditionally a very inaccessible asset class due to the high barriers to entry. The minimum investment sums for PE is high, the holding period is long, and individuals have limited access to good funds. However, our Astrea V PE bonds can mitigate these barriers to entry. and connect investors to private equity through the following. Firstly, Astrea V bonds allow for bite-sized investments, which means investors do not have to put in large amounts of capital in order to invest. For the Class A1 bonds, the minimum subscription is Sing dollars 2,000, and the bonds are traded in denominations of Sing dollars 1,000 on SGX. Secondly, investors' capital is tied up for a shorter period of time. The Astrea Class A1 bonds are scheduled to be redeemed on year 5 if conditions are met. Lastly, the Astrea V bonds are backed by cash flows from a mature and diversified underlying portfolio that mitigates the J-curve effect. At this juncture, I will pass you to En Yao, who will provide you with an overview of Astrea V.
Thank you, Margaret. My name is En Yao, and I'll be taking you through the Astrea V transaction over the next few slides. To summarize, the Astrea V PE bonds are backed by cash flows from private equity fund investments. Astrea V has a portfolio of 38 private equity funds valued at $1.3 billion. The most senior class of Class A1 SGD bonds is being offered to retail investors in Singapore. These bonds will be listed on the main board of SGX and traded under the stock code 5A1B. The public offer of the Class A1 bonds is 180 million Sing dollars, and the bonds have a fixed interest rate of 3.85% per annum, payable semi-annually. There will be a bonus of 0.5% of the principal amount payable to Class A1 bondholders at redemption if performance conditions are met. We will elaborate more on the performance threshold later. The Class A bonds have a legal maturity of 10 years, but a mandatory call at the end of year 5 if there are sufficient reserves to redeem the bonds. The scheduled call date is 20th June 2024. If the Class A bonds are not redeemed on the scheduled call date, there will be a one-time 1% step-up in interest rate to 4.85%. This is the transaction structure chart and the key parties involved in Astrea V. The transaction structure is managed by Azalea and administered by Sun. Sun is an experienced administrator, and its parent is listed on the London Stock Exchange. On the right are the other counterparties involved in the transaction. Besides the bondholders, we have DBS and Standard Chartered Bank acting as credit facility providers. The credit facility can be drawn for capital calls or to pay bondholder interest during cash flow shortfalls. Other counterparties include the hedge providers, as well as bonds and security trustees. Here, I want to explain in simple conceptual terms on how Astrea V PE bonds are backed by cash flows from 38 private equity funds. The issuer, Astrea V, indirectly owns the 38 PE funds. Altogether, these funds have invested in a total of 862 investee companies. When these companies are sold by the PE fund managers, the cash is distributed to the issuer, Astrea V. Astrea V cannot use the cash to acquire new PE fund investments, but can use it to fund capital calls at any time. At the end of every 6 months, any remaining cash must flow through a waterfall called priority of payments. How the cash can be used is strictly governed by this waterfall. The cash is used to pay for expenses, to pay bondholders' interest, and set aside cash for bond principal repayment. This slide is a simplified illustration on how the priority of payment works. Let me run through the various clauses. Clauses 1 to 4 represent key fees and expenses necessary to run the structure. In Clause 1, available cash flow is used to pay for any taxes and administrative expenses up to $0.9 million per distribution period. In Clause 2, the payments are made under the hedging arrangements. In Clause 3, payments are made for the management fees. In Clause 4, payments are made to pay commitment fees for the credit facility, as well as any interest and principal if the facility is drawn. Clauses 5 and 6 represent interest payments to all bondholders, with Class A bondholders ranking ahead of Class B bondholders. Clauses 7 to 10 represent cash used for reserves and principal repayments. If the issuer sells any of the PE funds, Clause 7 ensures that the net cash proceeds from any sales will be used to fund the reserves accounts or to repay any outstanding bonds. Clause 8 allows sufficient cash to be built up to redeem Class A bonds. Regular reserves amounting to 1/10 of the principal amount of Class A bonds are set aside every 6 months for the eventual repayment of Class A bonds at the end of year 5. In any period, if the scheduled amounts are not fully reserved, the issuer has to make good on any outstanding amounts in the subsequent period before continuing with the regular reserves schedule. When Class A bonds are fully redeemed, Clause 9 will start sweeping 90% of cash to amortize Class B bonds. Before the cash can flow down further, the maximum LTV ratio test is applied to ensure there are sufficient assets remaining in the structure to protect bondholders.
If the 50% loan-to-value ratio is exceeded, any remaining cash under this clause is used either for setting aside more cash in the reserve accounts or repaying the bonds until the loan-to-value ratio falls below 50%.
Clauses 11 and 12 takes care of any junior expenses, and Clause 13 is the payment to the sponsor as owner of equity. I've mentioned the performance threshold earlier. Performance threshold is met when the sponsor received $407 million before year 5. When the performance threshold is met, two things will happen. 1. Class A bondholders will receive a bonus interest equivalent to 0.5% of the principal amount at redemption. 2. Sponsor sharing will kick in. From that point onwards, sponsor will share half of the cash flow otherwise due to it pursuant to Clause 13 with the reserve account until the cap is reached. In other words, there is a possibility that the reserve account will be fully funded before the end of year 5. However, any redemption will take place on the scheduled call date, which is 20th June 2024. This slide highlights the 3 key credit strengths of this transaction. 1. A diversified and mature portfolio. 2. An over-collateralized capital structure. 3. Structural safeguards in place. I will go through the key credit strengths in more details. Key credit strength 1. A diversified and mature portfolio. The Astrea V portfolio is geographically diverse, with 56% in the US and the balance in Europe and Asia. US is the most developed private equity market, while Europe and Asia are fast growing and provide diversification. The Astrea V portfolio is strategically focused, with over 80% of the portfolio comprising buyout funds and the remainder in growth funds. There is no single name concentration in any funds or managers. The portfolio is diversified across vintages. The portfolio has a weighted average age of 5.4 years, as a more mature portfolio is cash flow generative. This helps ensure that Astrea V will benefit from the cash flows over the duration of the bonds. The portfolio comprises 862 investee companies across different industry sectors. The largest investment is less than 2% of the portfolio NAV, showing how well diversified the portfolio is with no single company concentration. Key credit strength 2. Over-collateralization. The capital structure is over-collateralized and the total amount of bonds issued represents less than 50% of the portfolio value. This means that the value of assets is more than twice the value of the bonds issued. Investors should also note that Class A1 and Class A2 bonds are ranked equally as the most senior class of bonds. Key credit strength 3. Structural safeguards. Astrea V has several structural safeguards in place designed to protect bondholders. Firstly, there are reserve accounts. Cash is reserved every 6 months over 5 years to build up sufficient cash to redeem the Class A bonds. Secondly, there is a sponsor sharing mechanism. This enables a faster build-up of reserves for Class A bondholders after the performance threshold is met. Thirdly, there is a maximum LTV ratio protection. Astrea V is over-collateralized with $600 million of bonds backed by cash flows from $1.3 billion portfolio, representing a loan-to-value of 45.3%. This structure must maintain an LTV ratio of 50% or less at all times. If the LTV ratio exceeds 50% on the distribution date, cash cannot flow to the sponsor and must be diverted to the reserve accounts, and if necessary, repay outstanding bonds until the maximum LTV ratio is no longer exceeded. Lastly, there is a credit facility in place. In the event of cash flow shortfalls, we have a credit facility in place to fund certain expenses, including management fees, interest expenses, and capital calls. This ensures investors receive their regular interest even during cash flow shortfalls. The credit facility can be used for both capital calls or key expenses, but cannot be used to repay principal of the bonds. All investments carry risks. Some key risks of investing in Astrea V PE bonds include investment risk, market risk, and leverage risk. The nature of private equity fund investments is that the amount and timing of distributions are uncertain. In addition, there are limited disclosures with regards to the underlying investee companies and their performance. Adverse macroeconomic or market conditions could result in falling PE asset valuation or reduction in deal activities. This may lead to less distribution from fund investments if the underlying investments are sold during a period of declining asset valuation or deal activities. Portfolio PE funds are likely to employ leverage. Use of leverage may expose investee companies to adverse financial or economic conditions and impair their ability to finance operational and capital needs. In a rising interest rate environment or an unfavorable market, such leverage could result in substantial loss to the portfolio PE fund and/or the investee companies, and thus adversely impact the cash flows to Astrea V. Before we wrap up this presentation, I'd like to do a recap on some of the key takeaways. Astrea V Class A1 PE bonds are the most senior class of the bonds and are available to retail investors in Singapore. The bonds are backed by cash flows from a quality portfolio of 38 private equity funds and is diversified across 862 companies globally. The portfolio is cash flow generative, and we have also built in structural safeguards. We expect a credit rating of A from Fitch and A+ from S&P. Before you invest, it is also important to understand what you are investing in. As such, you can read more about the Astrea V PE bond in the prospectus and the product highlight sheet. You can also pick up brochure or visit our website to watch our online presentation and explainer videos. You can apply for the Astrea V Class A1 PE bonds through the following means as shown on the slide. With that, thank you for viewing our presentation. You may wish to visit our website for more information.